Howdy, Jacob here. Today we're looking at Becton, Dickson and Company, ticker symbol BDX, in the healthcare equipment and supplies industry. $67 billion market cap on an $80 billion enterprise value. I don't know if I've heard of them before. There might be some companies that they own that I've probably heard of, but that is insane. A $67 billion company founded in 1897 out of New Jersey. Pretty high valuation right now that I see, with the operating margin pretty in line with history. So initial assumption probably going to be a bit on the pricey side, but let's still evaluate it. Revenue growth is over double, but earnings per share is actually down. So operating margin up a little bit, gross margin up quite a bit, but margin on the gross margin percentage and operating margin percentage are actually down on both of those. Return on invested capital is 3, 4, 5%. So pretty poor return on the money that's reinvested back into the business. Historically, $1.4 billion cash on hand with $1.1 billion short-term debt. So enough to write off short-term debt, but they have almost $15 billion in long-term debt. So that $15 billion in long-term debt is going to be about 7 or 8 times their 5-year average free cash flow. That's a pretty hefty amount. That means that it would take 7 to 8 years to put 100% of the free cash flow to pay off all that debt. Obviously, that's not likely to happen. They'll likely refinance and such, but that is a pretty hefty ratio and definitely more than what I want to see. So that will dampen what I will put as assumptions for capital allocation for this type of business, because I'm going to presume that 20 to 30% of their money is going to be going towards debt reduction, because you have to do a balance of what you want the company to do with what the company has done historically. So we can see that they currently pay a dividend that pays out $1.1 billion. That's about 50% of their 5-year free cash flow. It's about 1.6% yield. Acquisitions, a little bit of money. Share repurchases, a little bit of money, leaving just about 10% of their capital allocation to debt reduction. I'm going to increase that to about a 20 to 30% for my projections. Let's start making some projections here. I think it's already so big, I think it'd be tough to really see a plethora of growth here, but they do make a lot of acquisitions. So I think I'll probably stick with a little bit conservative, but maybe 4% I think is somewhat reasonable. You're going to put in a 20% of capital allocation towards making acquisitions. Maybe every 5 years you make a $3 billion buy. I think that could make sense to give them that type of return, with margins maybe in the line of, let's do 9 and 10%, a little bit of a range, maybe 9, 11. Share change, what's their stock-based compensation? 257. That's about 10 to 15% of capital allocation. I think I'm good with that. So I'll just say they offset their stock-based compensation with their capital allocation to share repurchases. I mean, it's a huge company. Like I said, I've never heard of them. They might have some type of moat status in peripheral IV, advanced peripheral catheter, central lines. I could ask my wife who works at the hospital, but I know she works on the cardiac floor. So, I mean, she probably seen these IV things. Maybe she hasn't seen them in the hospital she works at, but I'd be interested to talk to some other nurses and see what hospitals they've seen Becton, Dickson and Company in. But for me, I mean, 4% growth with just, I don't know, a little bit less than market average historically is about 15 or 16. And I mean, I don't think the growth's there. I've never heard of them. I don't know if the growth, everything else is really there. Their dividend currently pays out about 50%. I'm going to keep that the same so that it dwindles down to maybe 40%, which will leave, again, 20 to 30% of capital allocation to go towards debt reduction. So we're seeing about maybe, let's say, 25% debt reduction, 45% to dividend, 20% to acquisition, 10% to share repurchases. That gets us to all these assumptions, and we're saying it needs to drop 75% before you get the return we're looking for here. Again, I thought it was expensive given the fact that There's already a 50 PE, growth was small, already had higher margins, and right now I just would want to wait to buy this company at this price point. But hopefully you enjoy the video. Have a great day. Thank you.